Welcome to another edition of Chart Talk. I'm Tony Ogorek. I'm here with Jeff Viksjo. And today, Jeff, we want to talk about an increasing concentration in the stock market. In other words, almost all of the market's returns for this year are being driven by, 5, 6, 7 companies, and that's it. So we've got a couple of charts to examine this. This has happened in the past, and I think it's really going to be interesting to see, what the fallout may be once this sort of fever breaks. So let's take a look at the first chart. This is a look at an equal weighted S&P 500. So we've got 500 companies that are going to get 0.25% each, opposed to the stock market, which we normally have, the S&P 500, which is the biggest companies get the greatest weight in it. And Jeff, what are you seeing here?
Yeah, so the top 5 names in the S&P 500 make up about 20% of the index. And these are obviously the largest companies. These are your Apples, your Microsofts, your Googles. They are all tech names. And so we're comparing the performance of that, where the biggest companies get the biggest weight, to just an equal weight, where every single company in the S&P 500 gets the same. And what you're seeing is that the cap weighted, where the biggest companies get the biggest weight, is way far and above outperforming the equal weighted. And what does that mean? It means the biggest companies are driving all the gains this year. We haven't seen this level of outperformance in those biggest names since the dot-com bubble, to be frank. So it's been a long time since we've seen such outperformance from those big tech names.
Right. So, Jeff, if people's memories sort of fade, that was about 23 years ago. So let's take a look at our next chart. This chart takes a look at standard deviation. So you'll see a zero line right in the middle of the blues. One standard deviation this happens about 65% of the time. 2 standard deviations, what you're seeing happens only about 5% of the time, because it's outside of that. It's 95%. It's outside of that. So when we see this tells an even more compelling picture, doesn't it?
Yeah, and Tony, it's almost, you used this analogy yesterday. It's almost like a rubber band being stretched. And right now we're stretching it to the absolute limit, where that 2 standard deviations, we don't get here very often. And what it means is those top companies are outperforming to such a degree that rubber band is being pulled and pulled and pulled. And eventually time has shown that it snaps back. And so, Tony, it's, this chart suggests that things will reverse eventually.
Yeah. And, Jeff, what happens eventually is that everybody who wanted to buy those companies has bought them already. And there is no fuel to prepare, to propel them any higher. And, we may be approaching that point right now. So, history tells us that once we cross that 2 standard deviation line on top, the market generally is taking a fall. And you can see that the best time to buy is when you are below that -2 standard deviation line at the bottom. That was at the bottom of the NASDAQ bubble. That was at the bottom of the global financial crisis. And that was at the bottom of the pandemic. We certainly are nowhere near that right now. So thank you for listening. And thank you, Jeff. Enjoy your day.